Today's Fed decision isn't really expected to produce much in the way of fireworks, with the biggest story around the event less about policy and more about personnel. Janet Yellen will be chairing her last meeting today before Jerome Powell takes over at the helm. Economic data since the last meeting has been consistent with the Fed's outlook, which has been upbeat on growth while at the same time reserved about ongoing subdued inflation, which it still expects will turn up despite the soft readings sticking around for longer than anticipated. With no pressure at today's meeting, it would make sense during this transition period for the Fed to keep the language in the statement mostly as is, perhaps with the exception of some minor tweaks. Certainly, with the hurricanes now well behind us, the Fed may have decided to drop those references. It's also worth noting that the personnel adjustment extends beyond the Fed chair role, with Evans, Harker, Kaplan, and Kashkari getting replaced by Mester, Barkin, Bostic, and Williams. It will be interesting to see how it all plays out going forward with this new composition, especially with tax reform out of the way and the US dollar under pressure, which could very well push the Fed more to the hawkish side than the market expects. We're also still waiting to find out about that personnel move relating to the next Fed vice chair yet to be appointed. As far as FX markets go, the euro is the currency to watch, with its importance extending beyond the liquidity influence and onto the charts, with the single currency inching closer to massive falling trendline resistance off the record high from 2008. Currently, that trendline comes in around 127, and we think it will be difficult to argue for any shot at a meaningful US dollar recovery until that trendline is tested. Fed guidance currently calls for 3 rate hikes in 2018, with the futures market calling for the first hike in 2018 to come at the next meeting in March. That's all for now.